Hi, good morning. All right, I just want to make sure everybody can hear me. So my name's AdaPia. I'm the Chief Marketing Officer of Patch of Land. Patch of Land is about a 2-year-old marketplace lender in the real estate space. We focus on commercial residential real estate loans in the $100,000 to $1 million space for residential and the $1 to $10 million for commercial. It's my distinct pleasure to be moderating this panel, and I'd like to first of all thank you, Luan, for your continued leadership in the space and for providing all of us the opportunity to talk about our businesses in front of a very prestigious audience. While the world of alternative finance and online lending has been exploding with consumer and business headlines, billions being funded, real estate has begun to make its own headlines and is becoming a hot topic. The panelists here today are founders and CEOs of their respective businesses and are a very successful set of entrepreneurs with a vision to change the way real estate is funded and by whom. Each one has a diverse approach to their business, but we all began under the title, so to speak, of real estate crowdfunding. Today, the terms to describe this business vary, but one thing is clear: real estate funding is officially undergoing a revolution. What I'll do today with our time is have each panelist briefly introduce themselves and their company, and then we'll jump into a few key questions about the opportunities in real estate. So I'd like each panelist here to introduce themselves, and then we'll get going with questions.
Jilliene, do you want to?
Yeah, sure. I'm Jilliene Helman. I'm the founder and CEO of RealtyMogul.com, and we're an online marketplace for real estate investing. Our vision is to be full capital stack. So what that means for us is that we are both an equity and a debt platform in commercial real estate. We want commercial real estate entrepreneurs to be able to come to our platform and get debt, equity, mezz debt, pref equity, a huge variety of different types of capital. And we capitalize that through 2 different types of investors, both retail accredited investors. We've got about 20,000 investors, and institutional investors. We've got a couple $100 million in commitments from institutional investors, predominantly for our commercial lending business.
My name is Brian Daly. Our company is Groundfloor. On August 31st, we became the first marketplace lender authorized to sell public debt securities to non-accredited investors backed by real estate. That makes us only the 3rd company since Lending Club and Prosper to effect such a model with the SEC. And we've been piloting the concept in Georgia for the last year and a half. Have been operating at a relatively small scale during that time, but are now expanding nationwide. We're in a limited release period for the time being, but look forward to scaling up this year and next.
Hi, good morning. Can you guys hear? Okay, great. Hey, good morning. My name is Heather Schwarz, and I'm one of the co-founders. I'm also Chief Strategy Officer of EarlyShares and Property.com. And so we are a private investing. Yeah, we are a private investing marketplace. We're based out of Miami, Florida. So we are capital stack and asset class agnostic. Yeah. I think it's the location of the mic. Let me just hold it. Sorry. So, like I was saying, I'll just hold it like that. That's better. Maybe I should. Yeah, the outfit doesn't work with these types of mics. So anyway, going back. So we are a end-to-end transaction engine and marketplace. Capital stack agnostic, asset class agnostic, although we do have a huge focus on shopping centers, retail, hotels. We do have a full end-to-end transaction platform. We focus on heavily on due diligence and compliance. We also focus on working with very high-quality, seasoned sponsored and matching them with accredited investors that are interested in those products. We are working with both U.S. and international investors. So we allow our clients to post their opportunities direct on the platform where they have that one-on-one relationship. We also pool together investors into special purpose vehicles for select products. And so as this whole industry is evolving, and we are seeing a lot of activity, a lot of movement and transformation in private investing, we are also moving along with that industry. So we just recently launched Property.com to be that marketplace aggregator of all of the activity that's happening in this sector. And so you're going to hear a lot more about that as we get into the panel.
My name's Dan Miller. I'm the co-founder and president of Fundrise. We're the first real estate crowdfunding platform in the country, launching in 2002. I feel like I've been on panels with Rodrigo since the way beginning. So we really began as real estate developers. Our family was in development DC. My brother and I were doing development. And we thought, well, why don't we allow individuals to invest alongside us in the deals? So we built the platform to fund our own transactions, and there was enough demand from other real estate companies. That's where we are now, raising funding for other real estate companies. We mainly focus on urban infill, rehab development deals. We source, underwrite the deals, we pre-fund them with our own balance sheet, and then we put them up on the website to allow investors to buy into it. We have deals for accredited institutional, but we also have non-accredited. And a lot of what we're trying to do is open up commercial real estate to a much broader population. Historically, individuals only have stocks, bond funds, and we think that individuals should have 5 to 10% of the portfolio in commercial real estate. And if you think about that capital shift, it's an enormous flow of capital in the future. So I think technology is finally entering the investment market, a mix of the kind of regulatory environment with the fact that the distribution and technology is there, and it's exciting to be in the middle of a big change.
And my name is Rodrigo Niño. I'm based here in New York, and we have been doing crowdfunding for large properties that we control. We are JV partners on the equity piece, and we have funded our deals with investors from 22 countries and 19 different states. We have reached already the mark of $140 million in common equity for 5 deals that we have here in New York. We also have an operation in Colombia, where I'm originally from, where we like to believe that we have the world record in crowdfunding with BD Bacata, which is a $300 million skyscraper, out of which $220 million were completely funded by the crowd, by a local crowd. And that's where we are right now. We're planning on opening up our operations sometime in the near future to third-party developers interested in a JV partnership as well.
Okay, thank you. So as you can see, there's a great variety of what everyone does, very distinct and diverse. One question I wanted to ask, and I know that I heard it because we're in the space together, but maybe if you could each tell me, what is the key innovation or the one thing you would claim your stake on that makes you different and diverse? I mean, there's so much here. The one thing that you're focused on, your one key innovation right now. We can start with Jilliene.
Yeah, I'm happy to start, and it kind of feeds into how I opened my portion of the panel. But for us, it's about doing debt and equity on the same transaction. So the concept that a real estate entrepreneur, a real estate sponsor can come to a single platform and raise 97% of the capital stack, right? We require them to have some skin in the game, but they can get a $10 million commercial real estate loan from us, and they can raise $4 million in equity from us and put in $500,000. That's our key innovation, is how do we stack the capital stack where the real estate company only has to have their transaction underwritten one time. The real estate company only has to deal with legal documentation one time to get 97% of the capital stack. And I think that's incredibly innovative. The way that we do it is through technology and through diversified capital sources, both retail and institutional capital sources. But we're using technology in order to effect that transaction very rapidly as well. Right? The majority of our transactions are done in 30 to 45 days. And I don't know that there's another platform, whether it's offline or online, that will be able to do that at the size and scale that we're building for.
I think for us, we've had a maniacal focus on the retail investor, and most of the innovation that Groundfloor has offered to the market is at a level of scale never before attempted, appealing down to the very base of the retail investor base. So we've built what we believe is the broadest capital marketplace for real estate. Of course, that has meant that we have needed to keep our transaction costs very, very small. Our transaction size is very small, and the innovation really is a regulatory innovation in having taken this model that we built over the last 18 months. And now it's happening to me.
Okay, good. I'm glad it's just not me.
Yep, it's not you. Taking this model that we've perfected over the last 18 months and now scaling it. So the same kind of thing that Lending Club did with a low transaction cost, a very high number of very strictly uniform investment securities, of course graded by a by an algorithm in the same way that they did. That's the innovation that we brought to the sector of real estate that we're addressing today.
So, as operating or under operating as EarlyShares, we've been in this marketplace for the past 4 years, and we've had a huge focus on due diligence and compliance, because what we realize is that yes, there is a huge opportunity, particularly within the real estate sector, especially when using new regulations to create these access points to allow new investors to access private opportunities that they just never had the opportunity to before. So, recognizing that this isn't just a technology play, this is truly, it's traditional investing, right? We're not changing anything. We're not changing those key components regarding education, regarding due diligence, regarding compliance, working with seasoned sponsors. But in that, we've also recognized that there's a lot of opportunity amongst other platforms. So in the past couple of years, we've seen the growth and expansion of about 140 commercial real estate focused platforms. And we understand that there is a need to particularly service the investor, to make this more of a simplified investment process for them, to help them to, hello, sorry. I'm trying, yes. To help break down the barriers and to help simplify, because as you're going to understand more about all of these different platforms, that everybody has a unique way of operating, everybody has a key focus and a niche that they're playing in. And so it's very difficult from an investor's perspective to understand what is going on. So under property.com, we are aggregating all of that activity. We are collectively bringing all of that together, making it very easy to understand, digest for investors, so they can simply select, source, invest, and track their investments and aggregate all of the activity that's going on.
So we've been a leader in a lot of innovation in real estate crowdfunding, but after doing it, then everyone else always does it. So we're the first to do non-accredited crowdfunding, which allows true retail investors. We're the first to do pre-funding of the deals, meaning the borrower doesn't have to worry about the funds coming in online. We guarantee it. But I think there's some broader market shifts that are more important as opposed to individual companies. And the two things that I think real estate crowdfunding are best suited to do is one, mid-sized transactions, and then two, distribute deals very cheaply. So we traditionally focus on deals 30 million and below, because if you go to a private equity fund and ask them to write a $5 million check, they're just going to tell you to leave. It's too small for them. They won't make enough fees. It's not worth their effort. They have a $2 billion fund. They can't put it out in $3 to $5 million increments. So where I think real estate crowdfunding is going to fit very well, at least initially, is in the mid-sized transaction, 10 to 30 million, where the developer's raising $5 or $10 million. That money is very hard to raise institutionally because it's too small, and I think real estate crowdfunding is very good at aggregating $1, $2, $3, $5 million. Second, on the distribution, we just had a deal launched 2 weeks ago, distributed it out. It was a 10% senior loan on a project in Gowanus near the new Whole Foods. Sold out in less than 24 hours, 62 investors, $5,000 minimum investment. No cost of distribution. We created an email, sent it out. There was a link. People clicked the link. They transacted electronically. The efficiency of that system far surpasses anything offline. I mean, if you guys have done private placements, dealing with signatures, collecting documents, funds, escrows. So it's the distribution of the investment online where the real efficiency is. And as the rules open up to allow more non-accredited investors, I think you're going to see digital media even accelerate that. So the things that we think in the industry of why real estate crowdfunding is focusing on the mid-sized transaction and then very efficiently and cheaply distributing deals online.
In our case, I have it difficult because, we are the boring ones, in the panel, I think. We have been focused on very traditional, commercial, large real estate deals in New York. So essentially, what I would say is that we have been successful at securing those deals, which is something that is not easy, in an environment like New York, which is highly competitive, even from an institutional standpoint. So being able to deliver that type of deal, to smaller investors that otherwise wouldn't have access to, I think it's essentially what we have been successful at doing. But what I would like to point out is more at the level of the industry, because there's really an innovative, proposition. I think that cooperation, for example, is going to be big in the future. I think that in this panel, for example, the notion of competition, quite frankly, doesn't exist. You can see here, that you have the coolest ones, the ones focused, in a specific strategy in the mid-market. You see access, across the capital stack. And all those propositions, are very valid. You see cooperation, throughout the different platforms. What I think is that crowdfunding is really bringing, the whole notion of access throughout different components in the industry. And with that access, everything will have to come down to cooperation. I see, like I was saying before, the notion of competition doesn't really mean anything to us. I can easily see, any of these companies taking down a portion of the buildings that we're bringing to the table. I could also see, we bringing access, to our international investors to something that Jilliene is doing, in a property that makes sense to her as well, because it just makes sense, And there's even if all of them were to come to New York, they wouldn't be possibly compete to us, and we wouldn't be possibly be able to compete to them, because the market is so big anyway,
Yeah, it's still a very small percentage of the overall market.
We haven't had the first deal. I wonder if we have ever had the first time, where we were competing, for a specific deal. It hasn't happened. Or somebody that said to me, listen, I'm thinking between investing with Fundrise or with Prodigy. That hasn't happened to me once. So I see a lot of cooperation, in the future.
Yeah, just to add on to that point, in addition to cooperation, it's also about collaboration amongst platforms. And so here's an example where we partnered with Peer Realty, who the CEO and founder is here in the audience today, where we syndicated and co-funded on a deal, a shopping center in Chicago together. My investor base, particularly my international investor base, has a large appetite for shopping centers with national credit tenants. So I saw the deal, gave Jordan a call, and him and I, our two platforms share the same type of vetting and due diligence process, so that just made it that much easier for me to get comfortable with the deal. And so we collectively co-funded and were able to close on a transaction in Chicago. And so just adding on to Rodrigo's point, collaboration, cooperation is incredibly important in this space.
Yeah, thank you for that. I do want to say, Dan, I'm really sorry, but I have to, when you said about the pre-funding and you said you were first, I'm really sorry, but Patch of Land was actually the first platform to pre-fund. I'm sorry, I have to, but it is a key innovation. So one of the things, you've already covered a lot of what I had here. I'm not texting, by the way. I'm writing down some new questions because we've been covering so much. We've been talking about what opportunities in the real estate space. So I just want to jump into something. It gets brought up a lot. And that's, is this a financial, a technology, or a real estate play in industry? Or is it a mix of all of the above? And maybe we can start with Rodrigo this time.
Yeah, essentially, I think it's all of the above, because it's about the access that technology provides us with, and essentially that enables you to have a third party syndicate that equity on your behalf if you're a developer, and do it efficiently and quite frankly, less expensively. On the other hand, it is also about the real estate, because it is access to what, and that's where you say, in what type of assets are we going to be investing in as an investor, obviously. So, and I think that you can go anywhere from a $2 million note, or even less than that, probably $1 million note on a deal, up to $50 million in common equity, which are the deals we have been focused on. So that gives you an idea of the type of deals you can handle. So it is the technology at the level of the crowdfunding, and at the level of the deal, you can go anywhere from very small to fairly large, and that's where we are today, with real projects.
Yeah, I think it's really a real estate finance business that uses technology. I think the technology in and of itself is not very innovative. It's relatively simple technology. It's using existing frameworks, existing platforms. Nobody's invented some special algorithm, search algorithm that's our IP. The value is in the deal flow, the underwriting, the distribution, the investor network. So, we probably source deals more efficiently because of the online platform. We definitely distribute deals more efficiently because of the technology, funds transfers, escrows. But in general, it's a real estate finance business that uses technology, and I think that's where the market's going. That kind of pure tech had its run, and I think digital media search, those types of things are pure tech, and now it's starting to hit traditional mainline industries where it's really looks like the traditional industry with a little bit of technology. So I think it leans more towards the real estate finance aspect than the technology, and I think the people that have been most successful to date have come from a real estate background as opposed to a pure technology background.
Yeah, so the way that I see it is that you have a lot of components all coming together as one. So the answer to your question is that it's all of the above. But if you look at this business, at its core, we are in the financial services business. A lot of people come into this market, newly are coming into this market and realizing the opportunity and thinking, wow, I'm going to get a white label website. I'm going to, throw together a few deals, and then I'm going to have a successful business. But if you look beyond the front, if you peel back the curtain of all of the platforms that you see here, we do have sophisticated technology systems, but still, that is just the wrapper of what's going on inside. So we are dealing with a component or a core of financial services, and then when you add on legal, when you add on education, which is incredibly important to this marketplace, then you add on marketing. Technology is just the wrapper, and it's just the process that makes what we're doing that much more efficient and that much more seamless.
I think we also think of it as a financial services business, but I think that's because of the angle that we're uniquely taking. I think the larger the real estate deals you're doing, the more the real estate is important. And what we really set out to create was a financial product and a financial services business. And I don't think any of us are thinking that the technology is particularly hard. It's incredibly important to build, but we have thought of it because the real estate that we underwrite or that we bring to be funded on our platform is really, it's probably the simplest form of real estate out there. 2/3 of all Americans are actually investors in single-family houses because they own one or have a mortgage on one. And so for us, it's really much more about the financial product than anything else, but I can see how in dealing with more sophisticated you guys are doing 3 World Trade over at Fundrise. You guys have done Skyscraper. These are sophisticated real estate deals, the types of things that Realty Mogul has taken on. I think all of these represent very sophisticated real estate transactions that are really at the opposite end of the sort of thing that we do. So probably the more sophisticated the real estate, the more important that real estate know-how and knowledge is. And the less sophisticated the real estate, the more important sort of the financial engineering around the product is, and that's really where we've focused.
Yeah, at RealtyMogul.com, I'd say we're a fintech company. So the fin in that is because I sell investment securities online. So we're heavily regulated by financial services regulators, FINRA, the SEC, the Department of Real Estate in a number of states, and we're selling securities. So you have to have some element of a financial services business. But I may disagree slightly with the panel. I actually think the tech is very hard. I think the tech is very innovative, and it's not the distribution technology, right? Figuring out how to service and allow 20,000 investors to transact online, that's not particularly challenging. What I think is particularly challenging, though, is bringing technology to real estate underwriting and bringing technology to real estate capital markets in general. So what we're trying to do from a distribution perspective, as an example, debt and equity on the same transaction, that's very hard to get all of those parties in one place transacting at the exact same time on 2 different forms of investment securities, but also doing underwriting and looking at underwriting a very different way. I'd argue that we're also, at least us, and I'd imagine the panel, as technology companies because we're being valued as technology companies. We just raised a $35 million Series B, and I can assure you I have a tech multiple, not a financial services multiple. So what that means is that we have to be innovative around technology. What it means is that our venture investors are expecting us to do 10 to 100 times the volume in transactions than traditional offline commercial real estate capital sources because we can scale with technology as opposed to scaling with human capital. So I think there's a huge component of technology, and as we think about where are we innovating, we're really not innovating all that much in financial services, right? I'm regulated the same way that offline platforms are regulated. We're truly innovating around tech.
So that's a really interesting, it's a really interesting set of answers. And I think a lot of it also has to do with the types of funding that we're talking about. I know Realty Mogul, you're focused very much on the debt, just like Patch of Land and Groundfloor. You're also doing debt. Well, you're in marketplace lending a lot, so you're looking at volume around loans as well.
We're not only focused on debt. We're debt and equity.
Yeah, no, I know. Sorry, I meant like you're focused on debt as well as equity, but you play in the marketplace lending space as well. And a lot of people here are interested in the peer lending aspect, and so I did want to bring that up because for us too, on the data that is important as part of the underwriting. So my next question is actually how do you accomplish your underwriting? How much technology, how much data, and how much human capital? For us, it's a mix. I don't think that you're ever going to be able to take the human element out of underwriting real estate safely. So I'd like to hear what everyone else thinks, and maybe we can start with Heather, and then we'll switch it around.
Yeah, so we have both. It is a mix. It's an online and it's an offline process. But since we focus so much on equity, it's really important focusing on the sponsor and getting comfortable with that sponsor for the first time, because that just sets the groundwork for us to get comfortable with them doing additional ongoing deals. And so we have an in-house underwriting team. We also have the upfront technology that helps us select and source and filter through the applications that we get. But again, it's not diverting too much from what offline financial services and real estate companies do behind the scenes. You're looking at your asset, you're testing and you're stressing the financials, you're listening to the story, you're understanding the market and the geography. There's so many components that go into the underwriting, and yes, that makes it a little bit more challenging, but again, getting comfortable with the sponsor up front helps with ongoing deals moving forward.
In our case, we have it easier because I would think that we do it the good old-fashioned way. As our deals are large, the smallest deal we have is probably $130 million. And we got senior financing, from Deutsche Bank, CIBC, and Bank of America worth $260 million. And we also partner up with a pension fund administrator that is also coming on the preferred equity piece and on the mezzanine financing. So, and the rest, and the common equity is the one we raised, through crowdfunding. So our deals are very traditional. So we underwrite our deals the good old-fashioned way. I have to say that while technology has been helping us, get some data and analyze information more efficiently, I don't see how, we would be replacing our underwriting with some sort of algorithm or anything like that. So I think that the innovation, I would concur with the other fellow panelists, other than you, Jilliene, because I think the key is in the underwriting of the deals, and I wouldn't replace it, with technology. I would make it more efficient with technology, though, but I don't see how innovation would be more than marginal for that matter.
Yeah, I think I kind of lean the same. It's basically technology is making it more efficient. We have a standard underwriting process where there's an investment committee review of a deal. We put together a term sheet signed, then there's a final underwriting package and final sign off, and that takes anywhere 2 weeks to 2 months depending on the deal. But we're sourcing and underwriting many more deals than a traditional shop. We have about 25 people, 8 of them real estate specific, and we're closing about a deal a week. So 50 deals a year with 8 staff is far in excess of a traditional shop, and that's because of the technology, but it's still, there's somebody in there underwriting it, interacting with the sponsor, making the deal work. So, maybe there is a fully automated way to do it in a decade or so, but I'd rather take my chances in terms of deal performance with people underwriting it enhanced by technology than fully digital. But we've considered things like crowdsourced underwriting, kind of having people from the crowd, elite members of the site, kind of putting their own review of the deal. So over time, you might be able to create mechanisms, somewhat like Wikipedia does. How do you tap the insight of a broad group of real estate analysts and people and use their technology and information? But right now, we just kind of are expanding the efficiency of it with technology, but still traditional underwriting process, traditional investment committee, traditional general counsel, and legal closing process.
I think the company that's done the best job of commanding, I think as Jilliene put it, a technology multiple for financial services business is Lending Club. I mean, obviously, they've done that quite well. And so I think it really depends on what you admit as technology. What do you consider technology to be? I mean, at some level, because we're all using the web at some elementary level, we're all using technology. Does that afford us the technology company multiple that we all wish for as founders and CEOs, right? We hope so, but probably not, right? And so Jilliene, I think, raises a good point about ways to use technology. And in underwriting in particular, you know, the largest deal we've done is not even $130,000, let alone, you know, and the smallest would be sort of $30,000. So we're swimming in sort of a different pool of real estate, and we have theoretically thought that if anybody has a chance of reducing this, as Renaud Laplanche said himself, to an engineering problem, it might be in single-family housing. I mean, that's one reason we became very interested in that. But even as we have looked at the practical application of doing $50,000 and $60,000 loans, there is enough margin in the business to allow for a fair amount of human mediation. The amount of technology that's used to value the asset and assess the creditworthiness of the borrower can grow and is growing over time. And so I think it remains to be seen how much true, I mean, I grew up in Silicon Valley earlier in my career. I mean, that's what I've seen, you know, compared to building embedded software for flip phones, with all due respect to our engineering teams, you know, this is not high tech. It just isn't. It may afford itself a technology multiple because it's an innovative way of using technology to provide a financial product and to apply regulatory constructs. But it isn't yet the high-tech product that I think perhaps Renaud would say he's built at Lending Club, that we would all like to build from a multiple and valuation standpoint. So I say the jury's out.
I agree with that, but trying to elaborate a little bit on Jillian's point, you know, the interesting question is, how will it look like 10 years down the road if you're right and it becomes a technology company? Because trust me, you know, I want the technology multiple myself.
Yes.
So don't get me wrong, you know, I want to underwrite the $200 million deal every week, you know, and put it out there and distribute it. So that is the real question, you know. I wonder how you guys see that, you know, going in the future, because.
And you actually stole the last question, which is, what is, in your opinions, each of you, what is the future of the industry as you see it?
I had a different answer when I walked into the panel, but my new answer is technology from you guys, right? I'm actually surprised by the panel direction. I mean, we're using a tremendous amount of technology. It's not done, right? By no way, shape, or form is it done. All of our transactions go to investment committee. I put my seal of approval personally on every single transaction. I sit on 3 investment committees a week. Our chief credit officer was formerly the chief credit officer of JP Morgan's, 32 years of experience in real estate. So a lot of this is still manual, but we're using a tremendous amount of tech, right? And I think that our tech multiples deserve. So what I'd love is to be pushed, right? If all of us start thinking of ourselves as how do we get more innovative, how do we use more technology, then on a panel like this, I'll hear a great idea to steal from one of you, right?
Perfect.
But I think it's got to be more tech, because you can't do small balance transactions, and maybe Rodrigo's the one exception, but for us, you know, our transactions are anywhere from 100,000 to 50 million. You do a bunch of $3, $5, $7, $10 million transactions, and you don't want to have 1,000 people at your company to manage overhead and manage margins. You've got to use technology to do that, and I don't see there being any other way. That's what I set out to do when I launched the company, right? Was really use technology in a very innovative manner. Obviously, we're selling financial securities online. My entire background was financial, not technology related. My co-founder's got the technology background, but I think we as a collaborative whole really need to start pushing the envelope in technology.
I couldn't agree more. You know, it's very interesting to see, because of what we do. You know, we analyze a ton of deals, but we only commit probably to 2, 3, 4 deals a year, you know, looking into our growth. So if you analyze it, you know, we don't have that technology requirement for the underwriting that you guys do. But I understand, you know, how we could potentially help, you know, being more efficient in the international distribution, because there's where really technology also plays a factor. So it's interesting.
I just think the future that we are all working on in one way or another, and that has to be true if you're in this room and interested in this industry, is that capital markets are broadening. Capital markets are changing. They're changing in real estate, and they're changing in other asset classes as well, and we are a part of that. And real estate is arguably, if not the most important asset class among them all, one of the largest, depending on how you define it, probably the largest. And I think what happens here in real estate crowdfunding to broaden access to the asset class at every level is probably the most important development, and what will reshape what it looks like 10 years from now is the breadth of it.
So on that note, in terms of broadening the access, I suspect that this industry is going to more of a data-driven industry, just like the residential market has gone. So if you think about yourselves, before you buy or rent a house or apartment, where do you go first? You're going to go to Zillow, you're going to go to Trulia, you're going to go to Realtor.com. So that's our thesis, how we see this whole market moving. So we believe that within private investing, before investors take on that decision and make an investment, they're going to go to a platform first, and they're going to go to a centralized research and data provider first. And that's why we have decided to expand beyond just having a platform for EarlyShares, and expand and develop and just recently launched Property.com to be that one centralized place where investors do go to make that investment decision.
So I really think we're at the beginning of a much huger shift in the investment world and the financial world that's much beyond real estate. If you look at what media, telecom industries, what happened the past decade is large centralized institution, publishing for example, they controlled all content, they decide who got it, when it went out, at what price it went out. And then blogs and Twitter were created, people could create content, distribute it directly online for almost no cost, and start to create these decentralized networks. Initially, the big firms thought, that's cute, somebody's posting about their own recipe. But once somebody has 100,000 followers, they're now their own publishing outfit, and for no cost, they can distribute content. I think you're going to see the same shift in the financial industry. Large conglomerate institutions, banks, control the majority of the capital. They're not really liked by consumers. They decide who gets it at what price, where it goes, very inefficiently with lots of overhead. And now you're starting to see alternative platforms using technology with specialized verticals, connecting directly to investors. And generally, the focus of large institutions is, well, that, they're raising a few $1 million. That's nothing. It's not worth paying attention to. But if you look at the scale and the exponential growth of digital technology, I think there's an argument to be said. These platforms are going to grow. They're going to have much less overhead. They're going to be able to distribute and underwrite much more efficiently. And then they're going to challenge the existing framework and the existing business model of large financial institutions. So I think we're probably one downturn away from that level of scale. I think right now we're at like peak multiples, peak excitement, peak everything, which is good for us, but we're talking about long-term business here. But I think within 5 to 10 years, you're going to see alternative tech-driven finance models threatening the business of traditional financial institutions. And I think that's going to be a major, major shift that's going to be beneficial for everybody, except for a few bankers who may be in this room.
I see, a full-blown marketplace. You're going to be able to come to one of these platforms and potentially access offerings in all the platforms. You're going to be able to buy into the World Trade Center that you guys are putting out, into one of our buildings here in New York, into something, in Coral Springs or in the West Coast or in Florida, and potentially international projects as well. You're going to see ratings, you're going to see debt, you're going to be senior, junior, you're going to see the whole thing.
I'd like to see a tab on E-Trade with our securities. That's what I'd like to see.
And likely secondary market is also something that we all think about and will be looking for in the future. So with that, our time is up. Thank you, everyone. Thank you so much. And thank you.